House in the middle is in Washington, D.C. in our United States in Capitol Hill. And we actually, I lived in the White House to the left and Scott lived in the greenhouse to the right. And that was our first flip. We found an abandoned house that just happened to be right in between us. And we flipped that house and we ended up doing 4 projects on that street and started the company. So we started off as residential developers and then moved into self-storage. And I'll kind of explain why in a minute. Today, we're headquartered in Golden, Colorado. It's where our office and most of our employees are. That's our team there on the bottom left. We just launched a national storage brand called Free Up Storage, and that's the logo to the top right there. Fun thing about 2020, we were recognized as the 8th fastest growing private real estate company and the 308th fastest growing private company in the United States, making the Inc. 500 list. A little bit about where we are today. We have over 6,000 units of RV parks, mostly storage, and one manufactured housing development. We have about 35 full-time employees, 130 million under management, 200 investors in our network. Haley, that number's jumped a little bit from the last time we spoke. So we're about $42 million in private capital raised. And we have 10 completed projects. This is a little bit of our corporate team. We basically are a vertically integrated company, which makes us a little bit unique, where we raise capital, we buy projects, we operate them, do all the property and asset management. And we're also a construction company where we have a licensed general contractor on staff, and we're doing a lot, self-performing a lot of our own expansion and construction work. And then we take the project all the way through to disposition. So why storage? So we looked back in 2015, 2016 at this chart. As you can see, the chart ends at 2016. And we said, what asset classes did the best during the last 2 recessions? And that was self-storage. Self-storage was a standout. Self-storage performed the best during the last 2 downturns, along with medical office. So we wanted to know kind of what would happen in a recession and how to sort of position ourselves to be in an asset class that protected us from the next downturn. In coronavirus times, self-storage has proved its darling status. We've seen high occupancy, low vacancy, raising rents. We've had no eviction moratoriums. We're not really struggling at all, frankly. In fact, self-storage is probably fuller than it's ever been, and more competition has poured into this market to buy self-storage because of the resistance to economic downturns. So we also looked at this and said, the self-storage REITs, outperformed the S&P by more than 3 times. So we really liked the fact that it did really well during an uptime, and it also performed well considering during downtimes. So you might say, how many self-storage facilities are there in the United States? It's about 60,000. That number kind of fluctuates, kind of ebbs and flows. But as a comparison, as Americans, we love our self-storage for a variety of different reasons. If you took all the Burger King, McDonald's, Starbucks, Pizza Huts, Wendy's, there's about 50,000 of those restaurants total. And so there's about as many self-storage as 60,000 or so nationwide. So I always like to say, if it doesn't spark joy, people put it in self-storage on auto pay. So that's kind of our business model. But it's turned it into a $39 billion industry with 1.7 billion square feet rentable across the United States, 55 to 60 or so thousand facilities. And the average person in the United States, and it's different in every market, rents an average of 5.4. So if there's 100 people on this call, that would mean there would be, simply multiply that by 5.4, so it'd be about 540 square feet represented on the call, on the average. So self-storage is a very localized business. So you really have to understand the 3-mile market around your facility and the demand, the population of people, and how much demand there is based on how many competitor facilities are within your competitive ring. About just under 10% of households use self-storage. And the average monthly cost per unit is about $87. So, you may have heard the news. Q4 of 2020 was a very exciting time for storage. It became vastly more consolidated. So Blackstone paid about 1.2 billion and bought Simply Self Storage, their national brand, and all of their portfolio projects or portfolio of facilities, and it really consolidated the industry. Bill Gates just recently became a key stakeholder in StoreMart, and there's been anywhere from $400 million to $600 million grabs of portfolios throughout the United States. So the industry is starting to sort of build up a portfolio and then consolidate and sell, which is kind of our strategy at Spartan. So, some people say, is this just like American problem? I go to Europe, I don't see many storages, things like that. But, the reality is we have a lot of small business in the United States. A lot of people use storage for other things other than just, I have too much stuff. You may be thinking, I've never used storage. I don't understand it. And that's okay. I was actually in the same boat. But, when you look at our customer demographic, we see about 30% of storage users are actually business owners. So, we have like a nice big 10 by 20 or 10 by 25 unit. They may have a sheet metal business in there, a photography setup. Maybe they stashed a lot of their equipment. And, storage is dependent on life events. So if you're relocating, you're downsizing, there's job relocation, divorce, death in the family, things like that. Those are all drivers of storage. The one time I actually used storage in my life was when I have 2 kids and we were selling a house, and, we had to stage the house and get it all ready to sell. And we had to buy our new house. So we had all this stuff and, couldn't really go into the new house yet, but couldn't stay in the old house. So it went into storage. So that's a life event because I was upgrading my house because we have a growing family. So I needed more square footage. Great example of that. Sports teams, landscapers, there's a lot of different uses other than just, I don't know how to control my spending or control my consumption of goods. So there's a lot of different things that people use. Recreational vehicles is a good one. So beyond just, how this asset class did during the last downturn, when we looked at what asset class to invest in, we thought, what's easy to evict, easy to operate, and easy to own? And that was self-storage. There's really nothing better than it. I mean, there might be a, mobile home park investing or something like that, but you're dealing with evictions and things like that as well. But there's no tenants, no cabinets, no appliances, no countertops, low maintenance. It's easy to evict. And we'll talk about that on the next slide a little bit more. High occupancy, highly automated. And, the construction is very simple. So when we looked at vertically integrating our company and taking control of the whole value chain, these factors really played into that decision making, is that we check all of these boxes. So when we look at comparing against other asset classes, we all get into real estate because it's tax advantaged. I think there's no doubt whether you're doing a single family rental, multifamily, self-storage, you're going to have a tax advantage. You're going to be able to take advantage of bonus depreciation, cash flow, maybe some write-offs for running your business or running your property. It's all pretty consistent. Average stay, self-storage, our average stay is 59 and a half months across our portfolio. So a tenant staying almost 4 years, just about 4 years. So there is no national average or anything like that. It's kind of based on your portfolio and location and very facility driven, but our average stay is about 4 years. So it's very long. Multifamily, a couple of Google searches, it was a little bit all over the map, but 9 to 12 months typically. Single family homes can range, from long to short. So average stay is generally about the same. You can scale storage and multifamily a little easier than doing a bunch of single family rentals. And then the automation is really where we start pulling away. We can have a tenant show up, look on their phone, book a unit online, not talk to anybody, sign a lease, make a deposit. They're sent a gate code, they access their property, and they're in their unit. So it's highly automated. They also can book 24/7 online, or they can call our call center. So it's very automated. There's not a lot of people involved in the process of actually leasing up a unit. Rent recapture. So this is probably my favorite one. So in multifamily or single family or residential development or residential investing, if there's an eviction or somebody doesn't pay your tenant, it's a big deal. It's $5,000 for an eviction. Sometimes they tear a place apart. Sometimes you're legally not allowed to evict that person for a period of time. It can be very damaging to your profit. In storage, we comply with local and state law that allows us to evict the tenant or auction off the belongings. So if you put your stuff in storage and you don't pay, we have in the lease agreement the ability to lien the belongings and auction them off, usually within 30 to 60 days. So any profit we make on the sale of those belongings, we get to earn that. It pays us back for the rent that we lost and the expense of going through the auction process. So we essentially can get our money back in a lot of instances. Then we get our unit back, we get our rent recaptured through the auction process, and we have a rentable unit again. And typically there's not a whole lot of damage you can do to a unit because there's nothing in it. There's a bare floor and some, some walls, and it's not like there's drywall paint and carpets and all kinds of stuff that you're going to have to redo before you can start renting that unit again. So it's a very advantaged in that regard. And the last thing is low maintenance. If you think about a 300 or 400 unit apartment building, you're going to have 600 to 900 toilets. You're going to have 300 water heaters. You're going to have 300 kitchen sets and appliances. So in storage, you don't have any of those things. So you really have the opportunity to have control over your CapEx spends, and you can take on a lot less risk within that regard. So today we're going to talk about a property that we raised funds for and bought. It's in Pea Ridge, Arkansas, and if you're familiar with Walmart in Bentonville, it's about 10 minutes from Bentonville and about 10 minutes from the Walmart World Headquarters. Tyson's Foods. Great market for the economy, great demographics, and we thought that this was a great facility purchase. So we moved forward and raised both private debt and equity to buy the property. So one thing that the things that we liked about it is that it came with 108,000 square feet of rentable square footage. It came with 2 vacant commercial lots that we could build additional commercial development on. It had room for 30,000 square feet of expansion. And the big building, you can't really see it in the bottom right, but the big building had a lot of RV storage. And I know a lot of people are thinking, RV storage, man, there are so many people on the road with RV storage. It's so popular. Well, in this case, the previous owner actually regretted building it because they only leased it 20%. And their existing smaller units, regular, more traditional storage units, leased up to almost 100% in 10 months. So it's kind of funny. You think, RV storage, oh my God, there's a big need for it. But really, there's kind of 2 downsides to it. A, there's usually not as much demand as you think. And B, the rent per square foot is less than half. So if you're paying $200 a month for a big unit, 14 by 35, 40 feet deep, a 10 by 10, may get, close in comparison to that rent. So when you look at it from a square footage perspective, it's just less efficient. So what we're going to do, that last line there, we're going to convert 48,000 square feet into traditional storage. It's a little cutoff there in the words, but we're converting that into regular storage, which is a lot of demand of. That's going to raise the NOI, by double for that building. So it's a very strategic move where we can reconvert the building into that. So some of the things that we liked about it: new facility, high growth market. I think population growth has been a straight 2% annual per year and is projected to continue. And the facility opened about a year ago, and it's had a fast lease up to date. I think it's close to 70% occupied. So when we go into a property and we kind of evaluate a facility, we want to know what the market's doing. So one thing that we really liked is that you can see the blue lines are our subject property, and the gold lines are what the market was doing. So we saw that the market rents are extremely higher. I think on average 18% higher than our competitors. So we have the opportunity to not only lease up the property and provide value that way through the additional development, but we have the market that supports higher rent growth. So when people ask, hey, in multifamily, I get it. They kind of, to add value to multifamily, you kind of buy it and you take some units offline, you refresh the kitchen packages, you maybe do new floorings, or you add a water heater or a laundry, And then you can raise the rent $150 across, 100 units, and you can increase the NOI and the valuation of the property. What do you do for storage? I mean, it's just an empty box. Usually what you do is you look at the market and you understand where the market's at and what it will support, and find the gaps and inefficiencies in the market and take advantage of them, which is what we're doing with this, with Valleyets. We're simply going to move the needle on occupancy, better optimize the buildings, better optimize and train our staff, and move NOI by raising rents. So just a little bit about the project. There's the storage expansion area. There's actually room for 30,000 square feet. We only pro forma'd expanding it by 10,000 square feet because we just want to kind of see how that first conversion of the building goes. Came with 2 commercial lots. So that's kind of a flip picture in the front. You can't really see them all that well from the previous picture, but there was 2.5 acre lots that we're looking at building maybe a gas station or some type of retail in the front. And kind of talked about this before, but we're doing operational improvements to the project, rebranding the facility, increasing rents to market rate, training our staff, kind of putting our franchise on it, so to speak. So let's get to the meat and potatoes of this presentation. Why did we go raise private debt? That was a question our investor has. Well, why didn't you guys just go to a bank and get a loan, get a traditional loan and go that route? Well, a traditional bank loan, especially in COVID on a facility that has a pretty big development prospect to it, takes quite a while. Sometimes 60 to 90, maybe even we've even seen 120 days to close. So there was intense competition to purchase the property. This was a very good market, very good project, and there was a lot of buyers circling. So we had to do our typical due diligence, but we really couldn't have the cloudiness of a potential lender backing out or not being interested or getting unreasonable rate and terms. So, the partnership they had a partnership dispute. They wanted a fast close. And the other advantage is if we could close this inside 2020, we could get bonus depreciation for our investors on the equity side in the tax year 2020. So if they had some gains throughout 2020, we could offset those gains by giving them bonus depreciation. So, and ultimately we went to the sellers. They agreed to sell to us because of our fast closing timeline. We did a 19 business day close, and we had to waive our right to go get a financing contingency. So what was interesting is traditionally we can offer our investors equity. In this case, we offered them both debt and equity, and we'll kind of go into that. So I'm going to kind of go deep into private debt investing terms. So let's just talk high level what private debt is. So when you're giving a private note or you're lending to somebody as anybody other than a bank, that's private debt. That's kind of the 30,000 foot view of what private debt is. So usually when you're giving a loan, a private debt loan, you want to know what the terms are. So these are the terms that were presented. We kind of broke it down. So basically you might say, well, what are the terms? So the investors got a 1% closing point at the day of closing. So as soon as the property closed, $50,000 earned $500. And then the rate was a 7% per annum rate paid monthly. And the term of the loan was 6 months. So if you're looking at a private debt opportunity, and I have a list of questions, I have the top 8 questions that I would ask any private debt opportunity at a minimum. I could probably think of 100, but I'll talk about the 8 that I would ask. But my 8 questions are basically answered on this one slide. How much am I going to make? What are the terms? What is the security? Is there a guarantee? Background of the buyer or background of the borrower. Obviously, I would have sussed that out as I went along. When am I going to get paid back? What is the frequency of payments that I'm going to receive? And what is the leverage? Those are kind of my 8 basic questions. And, you can see here the loan amount, the loan to cost. So if you stacked up all the costs of the project and then you divided that into the loan amount, it should not exceed 75%. When is the loan closing? That's kind of a thing that you want to know. What type of loan is it? Is it amortized where there's principal and interest payments, or is it just interest only? So you're not getting any principal back. You're just strictly earning interest until the loan is paid off. What's the interest rate, and how do I receive payments? Some lenders will give you, or some borrowers will give you in a private debt situation, all the interest at the end. Some lenders will give you the interest as you go. And as you can see the top profile there, we're paying month one, $291, month two, $291. And so we're paying it monthly, and it's done via ACH. That's just a method of transferring funds. And my question is it guaranteed, and who guarantees it? So in this instance, the partners at Spartan, the owners of the company, personally guaranteed the loan. And we'll kind of go into what that means and what you should receive in paperwork to assure that you actually are getting a personal guarantee. And lastly, the collateral. This loan got a first position deed of trust on the property. So we'll talk about that as well. So on the equity side, this was the projections. We can talk about this because it's a closed project 506C, but the equity side received a potential a little bit more upside. However, they don't have the security of debt. So it's really important to know that as an investor, when you're making a decision, well, why wouldn't I just do debt or equity? Equity pays more. Well, equity comes with more risk, right? You flow with the project. If the project does really well, you might do a little bit better. If it does on target, which it never does on anybody's project anywhere, you might get a little bit less or a little bit more. If you miss target, you might do better. If you miss target the other way, you might do a little bit worse, right? Missing target's not a bad thing. It's just really hard to predict precisely what one could expect, right? In equity, you just don't know. Market conditions could change. Permitting could take longer. Construction could cost more. Pricing might not do that. So you're introducing a lot of risk. So this also comes with depreciation. We'll kind of talk about that. And this is basically kind of what the equity investors were looking at. So when you're looking at a deal that has private debt and equity, this is sort of like, okay, well, I'm making a decision. Do I want to do debt or equity, or maybe I want to do a little bit of both? So that's kind of what leads me to the pros and the cons. Which is best for you, equity versus debt? So when you're looking on the left side, the equity side, what we talked about, a higher potential for better returns. You have more risk, more inherent risk as an owner in the project. Equity provides bonus depreciation. So that's best for cash. So if you're sitting there and you're saying, well, I've got cash in my Quest account and I've got, cash in my checking account, which one should I use? Should I use my tax advantaged money or my cash? You might be in a position where it doesn't really matter. So you kind of got to look at the deal and decide, if you go into the equity side, generally cash might be the better thing. And I heard on a previous call, I think it was Kurt or somebody told me that Quest analyzes that you're going to lose about 1% IRR if you get subject to UDFI or UBTI. So it's really not a big deal, right? It's not a big deal. You're not going to have that big of a potential tax consequence in going in cash with your IRA or with into an equity side of it. You're also going to get a K1 that's going to give you a pass-through loss on your taxes, which is great. So it might be overall advantageous for using cash. Perfectly acceptable to use it in your IRA as well. On the debt side, things become more favorable to the IRA because, and we'll talk about the risk first, but, does it, debt tends to come with some kind of guarantee. It may not. And that's a great question to ask. Does it come with a guarantee? Who is the guarantee? Who is the borrower? What is their ability to repay me, right? If this goes wrong, will they be able to repay me, right? And that's kind of the big question. Debt has less risk than equity. Debt provides immediate cash flow. Obviously, on the debt side of this deal, it was a 6-month term. So if you want 5-year money to be in a deal for 5 years that, may or may not come back in 5 years, may take 4 years, may take 6 years, but generally targeting 5. You may want 6-month money where, you want to park some cash. Maybe you want to do a deal later in 2021 or whatever, but it's a short-term play on the loan. And there's stipulations to going beyond 6 months. There's an extension point. We're penalizing the borrower if the loan goes longer. Debt has a lower return projected, right? This doesn't mean you get lower returns. Equity might do worse. You don't know. That's the risk that you take. But debt generally has lower projections on its return than equity. Cash investors receive a 1099 INT. So if you're using cash, that's not the best tax advantage strategy, right? If you're using your self-directed IRA, you're not going to be subject to that earned income taxes. So it might be more advantageous to invest on the debt side if you're doing it through an IRA, because that taxes are protected, right? You're not going to pay that. And as Haley eloquently put, I'm not a tax professional. Do your own due diligence. This is just friendly conversation. So double check all this stuff with your CPA and your financial team. So again, that's just kind of the summary, just kind of getting your thoughts going. Well, why would I want to do, one versus the other? This is just kind of my decision tree and the pros and the cons of both. Just talking about the tax loss, I think this probably is worth bringing up. Bonus depreciation is a real thing. That's basically, we could spend an hour talking about bonus depreciation, but a cost segregation study happens at the property. They study all the different components, and then you can depreciate your short-term life in the first year. So, on this, the investors were projected to get a $15,000 loss for every 50,000 invested. So, if you have a lot of gains in the cash on your cash side of the balance sheet, it might make sense if you want to offset some of those gains with depreciation. That's really why we were pushing to close by the end of the year as well, because we wanted the investors to have that option of getting that depreciation almost immediately, because the deal closed in December and they're getting their K1s the following March. So that gives them that offset. Great. So some things that, there's loan docs. So if you think about going and getting your own personal mortgage on a house, notary comes over, or you go to the closing table and there's a pile of documents that you sign. It's really no different, probably just a little less documentation, but it's really no different for private debt investing. So this is a promissory note, and this is the actual promissory note. It's not the whole thing, but I just kind of snipped what I could for the purpose of the presentation. But this is a promissory note. What a promissory note is, it's a promise to pay back the loan. It's basically saying, these are the terms and conditions that I'm agreeing to, and the borrower signs it, and then the lender signs it. So you sign it as the investor, as a potential investor. So it's signed by both the borrower and the lender. And it specifies the rate and the terms and the stipulations of the loan. So it's saying, hey, if I can't pay this loan back in 6 months, there's a 1-point penalty, or $500 per 50, to extend it 3 months. This is what your monthly interest payments are calculated to be. It's a contract. It's specified how things will occur, and this is given to you typically to sign along with the borrower. I'm happy to share an example if that's requested. Personal guarantee. Now this is a big deal. So if a loan is personally guaranteed, that means if the business can't cover down and something happens, it means that the borrower is giving you a legal promise to pay the loan back. So if the business fails, typically if there's no personal guarantee, or if you're in equity, the borrower or the operator might turn that property back to the bank, and that's it. Everybody just kind of loses everything and we're done. As a personal guarantee, it extends beyond that security. So personal guarantee is a big deal. And it's basically an enforceable promise to pay, and it's a contract. And it's usually issued at the time of closing. So you can see we closed this loan on the 7th. It took a couple extra days because of the holidays. And we basically closed this loan, signed the guarantee, and we promised to pay the guarantee as 3 individuals, 3 principals in the business. Deed of trust. This is the next thing you're going to want to see. So a deed of trust is really important because it lists who the borrowers or who the lenders are. And it doesn't get into the promissory note stuff where it's telling you about extensions and the nuances of everything, but it's listing who the beneficiaries are, which is the investors. It's held by a third party, which is different than a promissory note. A promissory note is just an agreement between the borrower and the lender, the maker and the holder, right? So the trustee is usually a title company or escrow company that holds the deed of trust and then goes and records it with the county. This is critical because if there's no deed of trust, the property can be sold without repaying the loan. So if the deed of trust is if the property is advertised as being securitized with the deed of trust or secured in the first position, the deed of trust really is what drives that. So if there's no deed of trust, then you probably don't have a security on the property. And title holds that until the loan is paid. So this is really important. This is a recorded snapshot, just the top half of the deed of trust, about 10 pages long. And it's different in every state. So every state has their different requirements, formatting and language and how it's written and things like that. And the title company can kind of help you write a deed of trust to do private notes. And then, they usually have to be, when the loan is paid off, the borrower will typically require what's called a lien release. And that's what we're going to talk about next. So, we're now, let's say, hey, 6 months goes by, everything's great. And now it's time for the borrower to pay you off, right? To pay off the loan. That typically requires a lien release that needs to be notarized. That lien release then goes to the title company, and the title company will then release the lien so that it's no longer recorded against the property and releases it, right? And at about that time, you'd expect your money back, right? It's kind of I always joke, it's like a hostage situation, right? It's like, give me the money. No, give me the stuff, right? So it's kind of a little bit of, you sign the lien release and then the money goes back or in the other order. So it's kind of happened simultaneously. And usually you can mitigate that through a third party agent, like an escrow company. The money gets escrowed, and then once the release is signed, it goes back to the borrower or to the lender. And then the promissory note is simply stamped like you see on the page. It's paid in full. It's marked as paid. And then that's it. That sort of ends the arrangement with the private debt. So I know private debt's kind of a new, kind of something that, a lot of folks, either go use hard money or they invest in hard money companies. There's a lot of different ways to invest in private debt. But again, these are kind of my 8 things. So, in my mind, I want to be crystal clear on these. It doesn't mean the answer has to be yes to all of these or no necessarily, or maybe. It just means that these are things that I want to understand so I can go in with my eyes wide open when I do a deal and understand what risk I'm actually taking on. So number 1, track record of the borrower, right? If the track record is bad, it doesn't matter how great the deal is, the deal could fall apart. And then, if they don't have a great way to get out of it, then, that's really not going to drive anything. Even though it's secure, it could be secured by a property and be low leverage, and the borrower is a terrible operator, and things fall apart and it goes really bad, right? So track record of the borrower is probably my number 1. Is it personally guaranteed? Again, it doesn't have to be, but I kind of understand why it's not personally guaranteed or why it is personally guaranteed. And a nuanced question to that, is it a warm body guarantee? A warm body guarantee means, is somebody actually guaranteed, a physical person, not a corporate guarantee or the LLC guarantee or something like that. It's actually a person signing on the guarantee. And then I want to know who gets paid when. Am I in the first position, the second position? Is all the debt payments going out simultaneously? Just kind of want to know kind of where I am in the capital stack. My 4th question is, a loan secured? It doesn't have to be, doesn't necessarily make it a bad debt loan if it's not secured, but it's something I kind of want to know to assess my risk in the deal. What is the leverage? Is it a 90%, 100% leverage loan, or is it 50% leveraged? I want to know how much equity is in the deal. So if it does go bad, how much runway is left to get out of the project and get the debt paid off, right? Debt is guaranteed, but if it's guaranteed and high leverage and the deal goes bad, there might be a lower probability of that money actually coming back. And then what's the plan? What's the refinance process, strategy to end the loan? You say it's a 6-month loan, but what's your plan to get my money back, right? So what, as an investor, if you're putting up cash to a private debt loan, what is the borrower planning on doing to get that back? It doesn't make sense. Does it make sense with the business plan? Have they already talked to some refinance people, stuff like that? What are the rate and terms? Obviously, that's an easy one. What's my rate? What are my terms of repayment? Just kind of going through that. And then I want to know, if it's a security, is it recorded with the county? Is my name on the deed of trust? Do I really have a document? What's in the loan documents? What's memorializing this arrangement? Because, if you say all this stuff, that's great, but if it's not memorialized into a loan agreement, I don't really know what I'm doing. I could be lending without a security, or maybe the company that I'm investing in is getting the security, but I'm actually not getting the security. So if the company fails, well, they may be lending to a great borrower, but you understand kind of the separation there. It could be a problem. It might, not the end of the world, but it could be a problem. So just a little bit about Spartan. If anybody has any questions, this is our investor relations team. We love sharing. All Quest participants can get our 100 our 100-point due diligence checklist. So email any one of us. Our emails are easy. It's just Ryan at, Ted at, Lauren at. And we share our 100-point due diligence checklist item for free. It's the first 100 things we look at before we buy any property. And honestly, it could be applicable to residential, multifamily, self-storage. So we're happy to share that. If you want to learn about self-storage in the industry, we send out quarterly newsletters on that. That is our website in our newsletter. And I am at the end. Hopefully that was just enough time for questions and things.
Yes, definitely, Ryan. We do have a few questions in here. And guys, be sure to take note of Ryan's contact information here. They have a lot of great resources for you guys, but let's go ahead and go through some Q&A. We did get some questions throughout the presentation. And Ryan, you might have answered this one, but it's always a good topic to elaborate on just a little bit. But one of our attendees wants to know, what about UBIT? When investing into self-storage with your IRA, is it subject to UBIT?
I'm going to repeat your disclaimer, and then
Yes.
then we'll have a friendly conversation.
Mm-hmm.
So I'm not your tax accountant professional giving you advice. I'm not making any guarantees. Do your own due diligence and talk to other people that know what they're doing, right? I'm going to say that I don't know what I'm doing just to drive the point home. Generally, UBTI is unrelated business tax income. And, you know, I've heard it on other Quest webinars that, you guys, it's not a big deal. Don't stress about it. It might be a big deal, but it probably won't be. And you know, if you report it, it might be a 1% IRR hit to your deal overall, right? And I don't have any math behind that. I heard that from a Quest presentation, but I like it because it's, you know, I invest with my IRA and I don't see that impact of UBTI, and I invest in self-storage deals. Doesn't mean that I won't in the future. Right? Doesn't mean that I'm doing anything correctly. I'm intending to do the right thing and do it correctly. But again, I'm not a professional, so tax professional. So, you know, UBTI, generally my understanding of UBTI is like University of Washington, let's say, as a campus, right? And their primary tax exempt status is to provide education. But then they also do this big thing in the parking lot and they have a football game. That's unrelated business tax income. So that is the kind of stuff that starts tripping that exemption to taxes. So my tax attorney told me that in the storage business, if you don't have a lot of other stuff going on other than the passive leasing of units, it generally doesn't apply. So I don't know if that's a great answer, but I don't really, you know, I can't really say, but that's what I've been told.
Mm-hmm. Yes. And guys, if you have more questions about UBIT, reach out to us here at Quest, reach out to an IRA specialist. We do have several resources for you guys, but you want to make sure that if you are dealing with an investment that may incur UBIT, that you are meeting with a competent CPA who understands not only self-directed IRAs, but also UBTI as well. So give us a call at Quest. We do have some resources for you guys there.
I'll also just add one more thing to that. Not only, like, you guys have tons of great resources. Also make sure your CPA understands the deal and really, you know, we get questions from CPAs at the end of the year all the time, because we can help, you know, kind of talk through what's happening at the property as well, which may inform the CPA to make the best decision. So.
Mm-hmm. Yes, definitely. Got a question from Rob here. Rob wants to know, what are the stipulations on raising rent on current tenants who already signed a lease contract?
Yeah, for storage, the leases are 30 days. So we can raise the rent every 30 days.
Mm-hmm. Perfect. All right, let's see. And another question from Rob here. This is referring back to your last slide. Could you go over some of the common options with number 6 on the previous slide? Don't remember exactly which one that was.
Refinance strategy. So if so there's about 9 different ways you can get debt. You could refinance it with more private debt. That could be an option. You know, maybe you buy the property and it's not stabilized. Maybe the property's a mess, and you know, you might as a lender perceive more risk and get a higher rate, and then it may be refinanced into a new debt loan. So I'll give you a great example. We have an RV park that we bought that was an absolute disaster. We turned it around. We paid 12% interest, I think. And then when the project was stabilized, we reduced that interest rate significantly with new private debt. The private debt that was in there before just agreed to all stay in, but basically we had the option of going to a bank. The next option would be conventional financing. That's your local bank next door. They may not be interested in the construction of your property, but once it's built, they may be interested in taking you out. Institutional financing, life co, bridge financing. There's many different vehicles of refinance strategy, or you could improve the value. Everybody's heard of the term BRRRR, buy, renovate, refinance, repeat, where, and rent, right? You rent it out or increase the rents. So a lot of people will buy like a single family home. They'll dump $50,000 into a renovation. They'll place a tenant. Now the property's worth $250,000. They use private debt to get that going. And then they refinance out all the private debt and maybe all of the equity that they had into the project as well. So there's a lot of different refinance strategies, and you kind of have to understand, which way the borrower is going with that, and does it make sense with the project they're putting in front of you.
Mm-hmm. Awesome. Great explanation there. We have another question here. This kind of might pertain to both of us a little bit, but one of our attendees wants to know, he says, I really like to learn more about self-storage properties. Are you planning on presenting in the future on the acquisition and operation of self-storage properties? Ryan, do you have any further resources there?
Yeah. If you actually go to our website, there's a learn section, and we publish everything. We love providing education free and helping out other people that are getting into the space. There's a lot of information there. We like the Scott Myers group. They teach self-storage education. And I'd be happy to, I'm an open book on, presenting on, if you have more of a, hey, let's talk specifically about, how you go about buying them, how you go about operating them. I've got a plethora of presentations, happy to share kind of a soup to nuts business case on something like that.
Awesome. And I did actually make note of the suggestion as well and sent it over to our marketing team. So Ryan may have to bring you back to elaborate on those topics just a little bit more.
Sure.
Guys, we always love to hear the feedback from our events. If this triggers more questions, you want to know more in depth, always let us know. And don't hesitate to reach out to our speakers. We bring out people who provide quality education to our events and, great resources for you guys, even after this class ends. We do have a question here. Will we receive a copy of this webinar to rewatch? Yes. So everyone who has registered for this webinar, we will actually send out the replay, I believe within about 24 hours of the event. And then you can rewatch it on our YouTube page as well. So Kurt, our moderator today, if you could go ahead and plug that YouTube link in the chat just one more time. And I think that is all of the questions, or we do have one more here. What is your typical ROI for these types of investments? That's kind of a vague question there.
Yeah, and I'll give a vague answer. Typically, 2x over 5 years. But it depends. I mean, it's all over the place there, right? If you buy a perfectly stabilized property, you're going to get returns that are perfectly stabilized, right? If you buy a stabilized property at a low purchase price, you get a great deal on it. That return will go up, right? So, it depends, but reach out and we're happy to kind of go deeper on that. We can't really get into like conditioning the market or providing specifics on something like that. So generally we look at value add and ground up development as our two kind of main focus points.
Mm-hmm. Awesome, Ryan. Well, thank you so much for joining us today. This has been great information. I hope all of our attendees out there have found valuable information in today's presentation. Ryan, before we sign off, do you have any last kind of closing thoughts, anything you would like to leave our audience with as they kind of move forward into investing in the new year?
Yeah, there's a question that I think is perfect for a closing statement. So what's your site selection criteria? So what properties would we move forward to purchase, and what properties would we move forward to buy raw land and build brand new storages on? I think you got to be really careful because as exciting as this is, there's a lot of competition, and there's a lot of people that have the same idea that you do. So if you're going to go build a facility brand new from the ground up, you are taking on an inherent amount of risk, and you have to make sure that you go do a market study. And ideally, if you don't know storage, this isn't a real estate agent. This isn't your friend who lives in the neighborhood. This is somebody who studies self-storage data. And I'm happy to throw out a couple of recommendations, who will do an independent, unbiased study to tell you if you have the demand to what you're setting out to do. So when we're building 755 units right now in Washington, and we did a full-blown feasibility study. We do them in-house, but for that project, because it was so big, we said, you know what, we did our study and it passes muster, but we're going to go to a completely unbiased third party and get a study from them just to make sure we're good. And it was fine. It said the build. So, just make sure before you go flying into a deal, make sure you understand the market. We could understand that we raised those rents because we studied every single competitor. We studied every single competitor's occupancy. We looked at portfolio heuristics and averages to make sure that we understand how many people are going to move out to build our portfolio. There's a lot of work that goes into site selection. So if you take one thing away in the new year, I would say do your due diligence on the deal itself, because we are kind of we're in a hot market, frankly. And, we look at about 1,200 deals a year. And last year we bought 9 new assets. So, we're looking through, we have 3 full-time people looking at deals. It's all they do all day long is look at projects. And we say no to almost all of them, right? So, if you find that one deal and it just happens to be next door, it may not be a good deal, and that's okay. And, you go the distance and learn and fail. But just make sure you have the market study done. So whatever it is you're planning on doing could be backed up with real data. So.
Awesome. Great answer. I love always ending on those strong technical notes. So Ryan, thank you so much for joining us today. The feedback that we're getting in the chat and the Q&A section right now is nothing but awesome. I think everyone has appreciated the value that you've offered today. So thank you so much for joining us. I'm sure we'll see you at another Quest class or event soon. And I hope everyone out there has a great day.
Great. Thanks. Thanks,
awesome.
guys.
Yeah. See you later, Ryan. Have a good one.